everyone. Welcome to the early morning FOMC day. We're running out of FOMCs with our good friend Jerome Powell. We have to enjoy him while it's there. It's not coffee, by the way. This is a chai tea. Luka getting us to the semis tonight. I'm stoked for Luka, stoked for the Lakers. I don't care about the fucking Dubai Cup or whatever, where they make a fake semis in the middle of the season. I don't care. That's so stupid, though. That is such a dumb. It's a good regular season game. That's what I don't care about the NBA Cup. Chai means tea. I don't care. It's called chai tea on the menu. I'm gonna order chai tea. Okay, I'm not gonna. I'm saying I want tea and I want the chai style of tea. If I ordered tea, they wouldn't give me this. If I walked up and said, "Could I have tea?" They wouldn't give me this. But if I ordered chai tea, they would give me this exactly. So there is a difference. I don't care that you watched Spider-Man. It is. It is. So say chai style tea. That's more words. That's more words. Chai tea works great. You could just order chai. I can order the fucking chai tea that's on the menu, and I'll be happy doing it, and I won't care. Because in real life, the server's never gone, what, you just order tea? Chai means tea, right? That's never happened. Never in my life has that happened. It's only happened in chat from people that watch the Spider-Man movie. So, are you watching Game Awards tomorrow? Fuck yeah, I am. Wait, let me get this FOMC thing ready, bro. It starts soon. Go and watch FOMC live. We got any, like, music playing? Oh, listen to that. Hey, listen to that. Oh, Jerome can get down. Jerome has good taste in house, dude. Wait, let's, okay. How you guys doing this fine morning? Are you excited to hear about our economy from the esteemed Jerome Powell? I'm sure he'll say everything's okay. I'm sure. Have you watched the Almost Friday of it? I have not. Is today Thursday? I thought it was Wednesday. Maybe I watched one from last week then, yeah. Isn't it your bedtime soon, Unc? Ha ha ha! Hardy har har. I've been going to bed a little bit earlier as I establish myself as a healthy individual, and you're not going to make fun of me. You're not going to call me old. It doesn't matter. I am winning on this exchange because instead of staying up all hours of the night and ruining my sleep schedule, I'm getting a consistent good sleep. I woke up again at 6:30 today. I've never done that in my life, and I have energy. And I walked around in the sun with my dog. Like, do you understand the game changer? Do you understand how I'm levitating? Good sleep is overrated. All right, wait, we only have a few minutes. I need to jump into this, honestly. Because we have to do a little bit of setting the stage before Jerome Powell takes the stage, which could be in like 7 minutes. We're very close. So let's talk about this real quick. Okay, FOMC meeting today. Ladies and gentlemen, I'd like you to salute. I'd like you to give an 07. This is the last, actually, I'll say, by this time next year, we will no longer be seeing Jerome Powell. No home Jerome is coming to the end of his tenure. He has about, I think there'll be one in January and one in March, and then he's gone by May. And so this is the last last winter we'll spend with Jerome Powell. And it's an important one. Okay, so young. He's been involved in the Federal Reserve since 2012, appointed twice by Trump. starting, I think, in 2018 and then again in 22. So we're coming to a pretty monumental situation today. Now, again, I always remind everybody you have to do a quick primer because anyone's new. The main decision they make is around interest rates, aka the cost to borrow, short-term interest rates. If you think the biggest problem in the economy is jobs, not enough jobs, the economy's slowing down, you lower interest rates. If the biggest problem is jobs, you lower rates. If you think the biggest problem is inflation, you raise rates. You make it more expensive to borrow to slow things down a bit, to bring prices down. Okay? So these are the two choices. You lower or you raise based on what you think the biggest problem is. Now, as you might know, both of these are big problems right now. This has been the big problem of Jerome Powell's conferences all this year, where he says we have this dual mandate and it's in tension because we have two different directions we're being pulled. However, you've probably also noticed big layoffs at Amazon, big layoffs at Target, big layoffs at UPS, big layoffs at Starbucks, big layoffs at Intel, big layoffs everywhere, okay? It's been a horrendous job market this year. A lot of you are searching for jobs and finding it nearly impossible, okay? Quality jobs are, it was a no hire, no fire economy, and now it's like a no hire, quite a bit of fire economy. And so the general consensus seems to be that the job stuff is riskier or more danger, while inflation has been held to 3%, which is still above the goal of 2%, but it's not horrendous. So the job market is more scary. However, going into this meeting, a unique wrinkle has appeared. The FOMC, Federal Reserve, is flying blind because we have no jobs report. We have no jobs report. We have no inflation report because the BLS has been skipping them ever since the shutdown. Okay? So we're flying blind on government data that is usually really important to help the Federal Reserve make its decision. I also want to say, listen, I've thrown a lot of recession charts at you for over a year now. I've been pointing out, some real signs of weakness in the economy that are trending downwards. There are two new ones that I want to bring up that lead credence to the idea that the job market is even more important to focus on. Number one is that motor vehicle sales have, truck sales, you can't see the end of this chart, it's very important, have plummeted. This only happens, this is like heavy motor vehicles. This only happens, it's not like trucks like a F-150. This is like a heavy truck, okay? This only happens previously during recession. The shaded bars are recessions. You only see crashes like this in motor vehicle sales during recessions. We're seeing one right now. Additionally, you're seeing a huge decline in temp workers being hired. Again, all previous times you see these big declines in temp work, those are recessions. Even the very small 91 recession, which you barely notice. Okay? So there are a lot of signals that there's problems. Additionally, even though a lot of people said, hey, these tariffs are going to be bad for manufacturing in America, okay? They're not going to bring jobs back. They're going to create this inconsistency that makes people just avoid the U.S. or build things elsewhere. But then J.D. Vance said it's almost like the economic profession doesn't even understand tariffs. And he gloated because it wasn't an immediate effect. But now we flash forward, okay? U.S. manufacturing has contracted for 9 straight months. Maybe the tariffs are as bad as everyone said, okay? Maybe they're actually not working. So all of this adds up. Oh, sorry. Whoa. All of this adds up to a very predicted rate cut today, okay? The markets and the betting markets all had a 25 basis point rate cut today, 0.25 rate cut today. And guess what? As of 15 minutes ago, it happened. We got the cut, okay? However, there was a rare 3 dissents. Now, this is a vote. FOMC is a vote. There's a chairman, Jerome Powell, kind of leads the discussion, but it is a vote of the Federal Reserve Board. And there were 3 major dissents, which is higher than usual, who all said we need to either keep rates flat or even raise them because inflation is becoming a real problem. So we're getting to a real battle here, where within the Federal Reserve, there is big key differences on how they think it should approach what the economy is like going forward, what the biggest issue is. Okay? Trump has a very specific idea. He wants cuts. Donald Trump has wanted cuts loudly and insistently for his whole term. He would like a new Federal Reserve chair that will cut rates to stimulate the economy. He doesn't give a fuck about inflation. He said you can always raise them later if you get inflation. We need to boost the economy now, which is good for his polling, obviously. So that's what he wants. And that's what he likely is going to get in early 26 with Kevin Hassett. This guy is almost certainly going to replace Jerome Powell. And if you don't know this guy, we played a clip of him in the Black Friday episode. This is the kind of guy he is.
The fact person, $6,000 a family under Joe Biden, and it's up $1,500 a person so far this year. And with all that extra money and with the government shut down over so people feel comfortable going back to stores, that we're seeing a really blowout, Thanksgiving and Christmas coming our way. I think all the retailers expect that both online and in-store sales are going to be the highest we've ever seen. And the point is that that's happening even though inflation is way down under President Trump. And it was 5-10% under Biden, and right now it's running at about 2.5%. And it's way lower than wage growth. Right? And so people's incomes are going up by way more than inflation. And that's why we're seeing these blowout sales.
He's a massive Trump glazer who says the economy is amazing. He says inflation is way down. When the jobs numbers are bad, he says it's politically biased. So he's the guy that's going to come in and apparently cut rates in early 26. However, be careful what you wish for, okay? We got the cut today. They had the debate and they had the cut today. Any additional cuts after today into 26 are pretty much rock solid signals that the economy has slipped into danger. This many cuts in a row is a sign of pure panic. So whether they do it because he's forced to or they do it because they have to, we are entering into kind of the end game hearing into 26. Now it's time to listen to him speak. Let's see what Jerome Powell has to say about the economy with the data that he has.
Consumer spending appears to have remained solid, and business fixed investment has continued to expand.
Okay.
In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%,
oh, it's edging,
and that job gains had slowed significantly since earlier in the year.
Yep.
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well.
It has.
In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year.
They always predict just stopping and going
thereafter.
down. It's going to keep going up.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey base, a bit lower than the median projection in September. Thereafter, the median falls to 2%.
Okay. Perfect.
Our monetary policy action.
I want to pause. So look, they like if you go back and look at the previous projections, they always project inflation going down and unemployment rate going down. They always go, no matter what it is, it goes down. But then the real world, it always goes, the projection's not right.
Median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
He's saying my job is really hard, which it is.
A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point.
Yep.
With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings.
Yep, every meeting
this further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate
these are the votes
federal funds
of the different
rate
FOMC members?
under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4%
this is
at
probably
the end of
Kevin
2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy.
Okay. Caveats?
In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels.
Oh, this is where he's at.
Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities.
Oh, we're doing QE!
Bills for the sole purpose of maintaining an ample supply of reserves over time.
We're doing
Such
QE!
increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may
$40 billion a month
months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee...
Listen, this is all about the Federal Reserve's ability to print money, to buy government bonds, to control the interest rate on the longer term. I'm trying to make it less complicated. But essentially, quantitative easing is a couple keystrokes, new money going in so they can buy government bonds at the Federal Reserve. And we've been doing quantitative tightening, which is where they've been letting that shit run off. They've been all the stuff they bought before, they've been letting it expire and not repurchasing. Now we're back to QE, which is again another sign of stress in the economy, a sign of them trying to put liquidity and new money back into the economy.
Eliminated the aggregate limit on standing
We have been back to QE for a while.
These operations are intended
and then
to
I
support
also
monetary
mentioned
policy implementation. And
listen, they're going to find so many different fucking ways to use repo facilities, reverse repo facilities to get money into the economy to try and prop things back up. He's going to list a bunch of different fucking words that all boil down to that.
Smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
They do?
Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, questions. Dude, I think everyone's ready for some fucking rippers today.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last.
Like he's basically saying, if we cut again in 26, it's a sign of stress. He's saying we've cut it 3 times. We're probably in the range of what is an appropriate neutral rate. If we're cutting again, danger.
The Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup.
The expectations are buoyed on debt-fueled spending, top-of-the-K spending, and AI spending. Just massive, massive, massive money thrown at data centers. That is what is keeping these projections afloat.
Up in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve. Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of the risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking.
You're data dependent?
But yes, we have.
That's so hot.
If you go back, we held our policy rate at 5.4% for more than a year because inflation was high. Very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced.
Dude, it's so funny that like in 2 slides I said basically, if jobs bad, rates down. If inflation bad, rates up. And he has to repeat that in a fancy way 100 times to all these people in suits over and over. That's like half this conference. Why do they keep asking the same question and he repeats the same
setting? And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Yeah.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI.
Think about that. Think about that prediction. In the next year, we're going to get some fantastic increase in productivity from AI that doesn't create new jobs, but creates a ton of new growth. It's not happening. We haven't seen it happen yet.
Also, I think productivity has just been
the next
almost
version
structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right?
Yeah.
So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look?
I just want to say that is a pretty crazy statement on its own. That is that everyone at the FOMC agrees that inflation is bad and jobs are bad. And they're just debating over which one's worse. That is not like, we've watched conferences where they're like things are good, or they say they think it's good. But now they all agree that both of their dual mandates are bad.
And where do you ultimately where do you think the bigger risk is? And it's very unusual to have persistent tension between the 2 parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the
is this a fancy way of saying he doesn't trust it, bro? He's saying we're gonna eventually get a jobs report and an inflation report, but we have to be careful about it. I mean, I wouldn't trust it either if it comes out after it's been canceled for a month and they go, everything's great. Inflation has plummeted. Trump golden age.
Household survey. We're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call.
I mean, I agree with them.
We have to make decisions.
There's nothing wrong with having debates.
And
it shouldn't be all unanimous
lockstep.
lockstep.
The data will give us a clear read, but in this situation, you have competing.
I think that's 100% true.
If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation.
Like everybody gets it in this room.
I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick. Nick Timmeros of the Wall Street Journal.
Nick Timmeros.
Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of three quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
What a stupid fucking question. You've been listening the whole time, Nick Timmeros? He's going to say very obviously, it's not a foregone conclusion. We're very data dependent. Our dual mandate's in tension. We have the ability to both raise or, of course.
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy?
You shouldn't have any confidence that it won't keep rising in 26 because it will keep rising in 26. I'll say it with full confidence, Nick Temeros. The unemployment rate will continue to rise in 26. Okay? It doesn't just flatten out and go down. It's going to keep rising. I don't care what Jerome Powell says.
Notwithstanding the 150 basis points in cuts prior to today.
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Right.
Claire. Claire Jones, Financial Times.
FT!
A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead?
A little bit of fear?
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000.
I'm glad you can just say it. Yeah, it is overstated, bro. The jobs are declining. Yeah, I'm shocked he said that. Yeah. He didn't say 6-7, bro. He said, yes, dude. Yeah, that's why you have to cut, because the fucking, there's not 40,000 new jobs a month. There's negative 20K or more.
Per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought.
Dude, they always have to couch it in language like, it's all good. Like, like it's never like, damn, that's a lot of layoffs. It's always like the labor market is cooling so gradually. It's like a delicious pie on a windowsill. It's like just it's like, bro, for regular people, it's like, damn, I can't get a job. Everyone's firing. It's a breezy, cooling.
In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that this is that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate.
You're right about that.
Phillips curve kind of inflation. So we look at all those things.
You're right about that.
And we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample.
I mean, it's crazy to say that, inflation is out of our target rate, but we think it's okay because it's all tariff inflation, which won't happen again. It's like, I mean, he can't control the tariffs. I guess I don't blame him. It's just like, it's crazy that if you ask Trump, people like tariffs don't cause inflation. And it's like, the Federal Reserve is saying the opposite.
Reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions.
I want to see a chart of the Federal Reserve's balance sheet. Fed balance sheet chart. Just want to see. Okay, here it is. Before I go back to the chart, so this is them buying things with quantitative easing and putting it on the Fed's books. They take a bunch of printed money and they buy shit to help fucking get money out in the economy. And this period has been quantitative tightening where they let it roll off. But now, as of December 3rd, 2025, we are back to buying. It's back to going up. Okay? So I think it's a good visual to get you back on track with this.
That we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone.
I need to go over this transcript with a fine-tooth comb and really wrap my head around what he's saying here, because it smells a little bit like bullshit. Like, quite certainly we didn't need this level of reserves in many previous eras of the American economy. I don't understand why he's saying it's like, he's making it seem like this is a very normal thing. He's trying to put a lot of language to, but it doesn't sound normal.
For us to increase about
$25 billion
per
make sure I'm
month.
not missing something that he's saying.
So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and
the tariff
we
one.
think our
tariff one.
We don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for?
Just a little on that question. He was asking if because Supreme Court's about to rule on whether the tariffs were legal, and if they rule them as illegal, then all the tariffs will get canceled. They have to get refunded, which will drastically change, the Federal Reserve stance on inflation and yada, 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 yada. So, but Jerome Powell didn't comment on it because he's not trying to get political.
Thinking about what is happening in the economy right now.
Also, this guy does look like Jonah Hill. I mean, good call, Chad. This is like financial Jonah Hill.
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two.
It's not stagflation, is what you're saying?
And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, then we try to take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either
you're not
accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said,
just so
I
happened
think we're well positioned.
By happenstance, we cut 3 times in a row.
See how the economy performs.
Edward.
Into a cooling labor market.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months.
Question.
Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is.
So you don't know anything.
Call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. But and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No. He does have some Giga Chad moments. I like Jay Powell. It's a tough job. I don't know he's got to not panic people. He's got to balance the fucking dual mandate. He's got to, I give him credit where credit's due, but he is kind of like reaching the end of what you can jawbone, which is what they call it when they try to use their words to influence market perception. Like he's just like trying to project this air of they got it under control. It's like, no, bro, I don't believe you.
Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So this is a fucking great question. I want to explain it a bit. So the Federal Reserve only changes the interest rates, which is the cost to borrow on the short term, okay? But the 10-year yield, the 10-year borrowing yield for U.S. IOUs is kind of what sets like the prevailing interest rates for things like your mortgage or a long-term auto loan or a credit card loan. Like that's where the interest rates that you feel in the economy have to be around, okay? So, and the 10-year yield is not controlled by Jerome Powell or the Federal Reserve. That's just the market. That is people's confidence in the U.S. dollar. That is people's confidence in putting their money in U.S. treasuries. So if this goes up, which it has since they started cutting, I don't know, like September. It's like, I think this point in September they started cutting. In his question, they mentioned that it's up, okay? So this is what you want to get down. This is what Trump would like to get down. That's what everyone would like to get down because it brings down the interest rate on your mortgage and everything like that. But they can't control this. They can't just change that number. And his question was, okay, you keep cutting the short-term rate, and usually this follows, but it hasn't been. So why do you think cutting it again will make this follow? Let's see what he says.
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned.
I don't know what fucking surveys he's reading. I really don't. But here's a fucking bank rate survey. Most people say their pay is not keeping up with inflation. And basically they're saying that prices are rising faster than wages. So I don't know where he's pulling these surveys that most people say they project a sustainable 2%. I
mentioned that
we're not even close to 2%. I mean, we're
to get back to 2%.
Maybe 2.8.
Americans overwhelmingly are citing high prices, inflation as their number one concern.
Yeah.
Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs.
Yeah.
And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal. And
you haven't done that.
Our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about affordability,
right?
The affordability issue. And, so.
That's correct. But what I'm saying is nobody is expecting that. Every survey says, again, this is anomalous. Like normally in these surveys, 50 or 60% of people will say that they expect their wages to go higher than the cost of goods increases over the next 5 years or whatever. That's flipped. Now most people say that the prices will go up faster than their wages. So and you're cutting rates into that.
We're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Tough to answer, I guess.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2%?
Yeah, but what point is that?
Relatively stable where it is.
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down.
Dude, poor Jerome. Poor fucking Jerome. I mean, they're just grilling him on the fact. He's like, bro, it's tough. We can't do both, and they're both bad. I don't know what to tell you, bro. I got to do a mandate.
So the unemployment rate hasn't moved that much, but it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing the most of the inflation over.
Well, crazy for him to say that. I didn't even think he'd say that, because what he's saying is even if there were no tariffs at all, we'd still be above 2% inflation. And that's his estimate. That's crazy. That's crazy, man. Because like we have the tariffs, so now we're like closer to 3-something.
Shoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up,
Dude, I'm just so excited actually to see what Kevin Hassett's fucking version of this is, because he doesn't care as much about like Jerome Powell's constantly trying to balance the data and his dual. Like I feel like Kevin Hassett's gonna be like, bro, we cut again. I might cut twice in this meeting. I might cut right while we're talking. We're going to cut this time. We're going to cut next time. Let it fucking rip.
Keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think it's I don't think this is particularly controversial. It's very difficult to estimate
the birth death model.
Real time. They don't count everybody. They have a survey, and there's been something of a systematic overcount, and so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right, and that was exactly what happened. So we think that has persisted, and so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully.
Yeah, that's bad, obviously.
Where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And
Uber, Jerome, it's Uber. It's fucking gig work. People aren't firing for unemployment insurance because they're taking gig jobs. Okay? Unemployment is this huge fucking hassle for small benefits. It's not worth the fucking squeeze. So they work for DoorDash or Instacart or Uber or fucking as filler. And so it's not reflecting in the continuing claims numbers, but it is a rising sense of people opting out of searching for a real job. Okay?
Since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up.
There are big layoffs, but this time around we have gig work, and that's why you're not seeing it in the normal past. You'd see it.
Really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
I would argue that it is showing up in layoffs, but I don't think these layoffs are because of AI. I do think some of the reason companies aren't hiring new college graduates is because of AI, because they're trying to figure out whether they can replace that person's entry-level job with AI and a senior employee doing basically more work using AI. I think there's a bit of less hiring because of it, but the layoffs are not because of AI. The layoffs are just, they say AI so it's better for their stock price. If you lay off a bunch of people, oh, that looks kind of bad. If you lay them off for AI, oh, this company's forward thinking. And it's just, that's what it is.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation?
You won't comment.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you. Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts.
Bro, okay, so I've been talking about K-shaped economy for like a fucking year and a half. It doesn't come from me, even though people on Reddit are like, oh, K-shaped economy? That comes from Peter Atwater, who got it from a random poster on Twitter. Well, Peter Atwater's a guy I like to read. Doesn't have a fucking massive audience, but a good Substack. Peter Atwater is the one who first said K-shaped economy, and I've been fucking hammering that shit home for a year and a half. Because I think is the perfect description for what you're actually seeing in the real world. You see a big headline spending number, but you break it down and it's like the rich people who have house price up, stock price up, they're spending like crazy. They feel good. They feel great. Bro, I'll just be real. My shit's doing pretty good the past few years. But I'm not stupid. I just went back home, Arizona, spent time with my friends and family. Dude, a lot of them, same school as me, same age as me. Some of them are working as fucking teachers, different job. They're kind of low-key soft struggling because it's fucking hard. It's hard. Some of them are starting families. It's expensive. It fucking is just more difficult than it was in 2014, 15, 16, 17. Of course, it's just way more difficult, obviously. And it's just so wild that it's just not like more readily apparent. Like everyone's saying K-shaped now. And I hope he answers it. But it's like, it's such a dispersion, and when you average it all together, you can be like, well, yeah, look, the numbers up. But it's not, it's not really up. Most people aren't feeling that at all.
And just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So
it should be so clear. What he's saying is 100% true, and I don't think he was deliberately misleading. But it's not they tend to be owned. It's not like, well, I guess some of the assets are owned by the wealthy people. It's like 99% of all the assets, all the housing and all the stocks are owned by the top, not even 10%, but really like the top 2%. But if you do the top 10% of the economy, they have all the stocks, all the housing. So it's not 10. It's like, it just is. They are the ones feeling good because that stuff is up. And everyone else who doesn't have access to that is not really feeling good at all. Prices are up and their wages are not up to compensate. So everything just feels more expensive.
As how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market.
Dude, it's crazy because he's talking about, I don't even know if that's sustainable. And that's from a purely economic point of view. It's like, can we all last on everything being spent by the rich? But he's not talking about, it's not his job. But when you think about it, is that sustainable societally? Is that a societally stable thing? Is it a world that we can politically be in where a majority of people feel so disenfranchised in the economy? That is the bigger question. Like whether or not we can keep the numbers afloat on that system. He already is like, I don't know if that's sustainable. But that's not even the full question. The question is like, people are getting more and more radicalized at the bottom end of the K because they have no incentive to like try to be part of the system. There's no try to climb the ladder.
What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong.
Okay, so this is true, but I've heard this before too, and I kind of want to poke it at it. I want to poke at this because he's talking about a specific period of time, which is like the 2021, 2022 era. There were big jumps in wage gains, and it was because we had student loan forbearance you didn't have to pay. We had mortgage forbearance you didn't have to pay. We had like rental forbearance you didn't have to pay. Like so many bills were canceled. Everyone was stuck at home. We had COVID stimulus checks. We had so people had so much extra money. They felt comfortable being like, fuck it, I'm not working for that little money. This was the era, the 21, 22 era, when all the jobs were like, you can't hire anybody anymore. Nobody wants to work. And like they had to compete for employees. Employees had the leverage. This is a very small window of time. And so when you point to that and be like, oh yeah, look, I mean, we have this area where job growths were great. But now bills are all back. Okay? The bills are back. Yeah, they weren't canceled. I'm sorry. They were just kicked down the road. That's a great way to put it. So the bills are back. The excess savings people had from 21 and 22 is gone. They've ran out of that. And now they're relying on debt to keep their lifestyle going. And prices are up. So it's just a different environment. And it's like, you can't point to that and be like, well, they feel good because their wages are back up. That era is over. They have no leverage over the employer now. Now it's like an employer's market. Everyone's taking like whatever they can get to get a job.
Labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Well, I hate how she phrased that question. She phrased that question as, can we get some more affordability in the housing market so people can take part in that wealth creation? It can't do both. It can't be more affordable, but also be a great vehicle for wealth creation. If it's a great vehicle for wealth creation, that means it's always going up. If it's more affordable, that means it's coming down. You can't do both. Okay? It can't solve everybody's retirement problems and solve the need for everybody to have a house when they're young. So we have to understand that prices have to come down, and it can't be a vehicle for wealth creation. Boomers have to lose. Somebody has to lose in the housing market. And right now, people losing are young people under 40, people that want a house, want to start a family and can't. We need to switch it so that boomers lose, that their housing prices decline steadily in value. And it sucks, and I'm sorry for them. Again, I know it sounds like I'm joking. Many of them I'm not sorry for. There are people who saved and put money in a house for 30 years, and that's their retirement, and they want it to be a good value so they can sell it and live off it. I understand. Some of them will get hurt. I do feel bad for them, but societally, we can't function like this anymore. We can't function with the cost of just getting a home being so astronomically out of reach for the average person. And that's like not even close. It's not even on the radar. The boomers have to lose. I don't know how else to say it. They have to lose on housing. So.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point.
Or we could do 50, 75, 100-year mortgages. We get the monthly payment down so everybody young can afford one. And we keep pumping this shit up and we kick the can down the road. That also sounds great. Let's do that. Woo!
Decline in the federal funds
That'll be
rate
Gen
is
Alpha's
make
problem.
Much of a difference for people. Housing supply is low. Many people have very, very low low-rate mortgages from the pandemic period, and they kept refinancing and got the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing.
I mean, he's totally right. This is not Jerome Powell's problem. This is a societal problem. This is a government problem, but he can raise and lower the short-term interest rate, bro. It's not, he can't fix this.
Shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff.
I'm just saying. All right, I'm not saying me, but I'm saying that many people that I was reading in 21 or 22 were openly making fun of this idea that inflation was transitory, and it would be temporary. Like it was obvious to see that's crazy. We added fucking $20 trillion new dollars. I think that's. I don't know.
Inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs.
Being pro-inflation because you're pro-trans rights.
You see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Okay. Where's that?
One with Axios.
Dude, last time there was a great question from Yahoo Finance or whatever. It was Jennifer something, and she had a great question, and I want her to get one more question.
So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects.
Half these questions feel written by AI.
People who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed.
3 left!
Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
Oh, legacy?
Legacy. My thought is
we're talking
that,
legacy?
I really want to turn this job over to whoever replaces me,
Kevin,
with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want.
I'm sorry, Jerome. That was going to be tough. But I think what you might try to do, I think that explains what he's talking like today, actually. Now I sort of see his pattern. If he can just be like, listen, things are cooling slightly, but we're pretty good, and then hand the fucking hot potato over to someone else, then when it gets really bad, he can be like, look, bro, it wasn't on me. Shit wasn't on me.
And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about the bigger things. I hope many years ahead to
those are the biggest
worry about
things.
That, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't.
Oh, I didn't even know he could do that.
New on that to tell you.
I didn't even know he could stay on.
Last question.
That'd be wild if he did.
Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment.
Oh, really?
These things are hugely valuable to all the people we serve.
Dude, I feel like if Jerome Powell doesn't know the question, he just goes back to the dual mandate speech. I legitimately think, like, if he's like, I don't really know what that. I think he just fucking runs back. More reliable,
when we raise
bro.
rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Oh, that was it? All right, man. Jerome Powell, no home Jerome. We had 3 FOMCs left, and then he's gone. But not forgotten. You're in my heart always, Jerome. Interesting. He sounded more negative in the last, maybe the one before that FOMC meeting. This one, he sounded a little bit more iffy, a little bit more upbeat. But I do think it sounds like he's trying to, like, put a nice bow on everything before he hands it off. I was kind of wondering why he was like, the data is not improved. In fact, they don't even have data. And he's like, oh, well, things are good. I think he's like trying to wrap it all up and say, listen, things are pretty good. We're in a good spot. We're in neutral. Now it's your turn, young fella. And hand it over to Kevin Hassett. I don't know. I kind of made my point. Obviously I disagree that the unemployment rate is going to flatten out and then go back down. I think it's going to keep ticking up as it has been, as it does almost every time it ticks up like this. And I am worried though. I would definitely like them to not cut in these first 3 meetings if they can get away with it and try to hold steady, because Kevin Hassett's going to cut like crazy once he gets the reins, and that's going to be problematic on its own. I am worried about inflation once Kevin Hassett has his grubby little mitts on the job. But that's that. Why cut? He needs to bulk for real, for real. Jerome Powell, like 8 months after quitting this job, I've been bulking, and he's like fucking shredded. That'd be awesome. I hope he lives his best life after he gets out of this fucking job. Bro, I keep going to group interviews with 30 other candidates and they only hire 1 to 3 of us. Unemployment coming up for sure. I mean, yeah, like I said, bro, the rise of gig work is kind of obfuscating the numbers, but it's not good. You talk to real people, man. It's like no one who's looking for a job that they act like a career job, like a job they feel good about that has like growth potential. Nobody searching for a job like that can find work, or it takes forever. It takes fucking tons of interviews, tons of searching, 6+ months. Like those people are noticing. And so there's jobs that suck. And even those are getting tougher, but do you think economists miss the human aspect sometimes? Yeah, all the time. Yeah, I do. I do. I do. That's like the fucking core of my stream, is that I think they miss the human aspect. What do you think will happen if Hassett gets put in? I feel like it'd be catastrophic. I mean, he doesn't have an insane amount of control, right? But I think he'll ramp up quantitative easing and probably invent some new form of quantitative easing called like strategic risk management. They're going to invent something. I swear to God, this time around, this cycle, they're going to invent a new term that is around like, it's going to be some new term. They're going to have a different name, but it's going to come down to essentially printed money to bail out bad bets by banks or AI companies or whatever. And so that'll happen. And then I think he'll lower rates to make it really cheap to borrow. But, you know, all these things are stimulative, but they debase the dollar. So these are, you know, I do feel like gold has been kind of bubbly lately, but I haven't sold yet because the core thesis that Trump and Hassett can't get off this train is stuck in my head. I can't get out of it. That's just me. That's just my fucking head. This is not financial advice. I swear to God, I don't know. Everything's crazy right now. You used to hate Jerome 2 years ago, and it's been a 180. Bro, did you watch what I just did? You think that was fucking glazing Jerome? I never hated Jerome. I've always been critical of the things he says because he has to lie. He has to get up there and lie. But he's had a hard job. He's, you know, when you're stuck between rising inflation and lowering interest rates, or sorry, lowering employment, and you have to fucking, you're just rage baiting, bro. Is it true that U.S. credit ratings getting downgraded again? I didn't hear that. Is that true? Again? We got downgraded like 3 months ago. I don't see anything about what you're saying. I don't see anything. Not since the last time. Maybe.
The United States.
I think you saw this video from Clear Value Tax. There's always a YouTuber. Someone goes to the fucking question, there's always a YouTuber. I'll have to check it out, but this is not, like, there's no news about it. Did you know that the tech companies trying to build data centers are hiding their names until the project is approved, so their stock isn't affected if it gets blocked? That's sketchy. That is sketchy. All right. It bewilders me that the Fed and other reserve banks are so deep in the dual mandate sauce when I believe they'd be better off focusing on inflation only. Well, that's a little crazy. You think they should never focus on jobs? You think people losing their jobs is not? I don't know about that. I mean, yeah, Jennifer Schonberger didn't get a question. What the hell? Our queen. Jennifer Schonberger of Yahoo Finance, who had the best question last time, she was there and she didn't get a question? We had to listen to fucking 15 questions like, so if you raise rates, is that bad for employment or is that good? Can you explain the dual mandate again, Jerome? And it's like, we can get one good question. What's your legacy? We had to get that question. They fear her questions. I've been trying to catch you live to ask, how did you get through House Entries? Ray Dalio just glazes his other books and himself the whole time. He's not a great writer. I thought the book was really good. Listen, we just did a book club for this book. I was fighting for my life, bro. This is the book we just did for Lemonade Stand, and I'm the one that picked it. We alternate picking, and we just did the recording for it. I don't know if it's up yet on Lemonade Stand Patreon or whatever, but dude, Aiden and Doug didn't read it, and Aiden fucking hated it. So I had to fight for my life, bro. I had to fucking I'm like, he's a bad writer. Don't get me wrong. Don't get me wrong. He's a bad writer. And, you know, it's like one of those, you're trying to get your friend to watch an anime or something. It's like, get through the first 20 episodes. Like, the first half of this book is so boring. So I had to defend it all. But then I brought a little slideshow and I was like trying to explain, like, no, but there are some takeaways. It's Breakneck was a great book. This is not a great book, but it was interesting. It was interesting. Maybe I'll do a little presentation about it. Because the Patreon is like, it's like pretty small, you know, group of people compared to like a clip or a video. And I want people to talk about it. Did you think what happened if Netflix gets parts of Warner Bros. They want Paramount just buy CNN? That's what I think will happen. It's still a bidding war. We don't know yet. Does Jerome see the questions beforehand? He does not. No, they're live. Really cool video on the rise and fall of nations. He mentioned you. A YouTuber made a video about the rise and fall of nations and mentioned Glizzy Hands Atrioc. Am I the reason of the fall of nations? Am I a sign of the downfall? Or is it because I've been around for so long? I'm so old that I was there for rising and falling. They found a picture of you back then. You are a sign of the times. AOE2 gameplay. Donald and Co. keep devaluing the USD while the government uses most international classified and other competitors. It's a very complicated question, bro. Listen, it's not like the Chinese RMB is a great reserve currency. But there is a sense that maybe an international payment system that is settled in gold that China's kind of building towards will be more popular if they keep devaluing the United States dollar. Yes. I did see, I heard about some of the Gavin Newsom stuff, but I was going to do that later. I think I'm about to end stream and come back on later. And I'll talk about that, and I'll talk about Australia and their social media ban. That was sort of my plan. Because this was just a morning stream for the stuff. Of the Jerome Powell stuff. However, is there a Lakers game tonight? Maybe I should fucking talk about it now. 7 p.m. Lakers game? I can't miss it. I can't miss it. Maybe I should talk about this shit now. Maybe we just fucking start farming, bro. For the EU frogs. We'll have to do Australia tomorrow and talk about... Okay, fine. Wait. All right, stick around. Wait, I'm changing my title. I got glazed by... Well, that's a terrible title. Gavin Newsom glazing me in NYT? Okay, boom, title change. All right, here's the fucking tea. Apparently, who's got the video? Apparently, where's the video, bro? Okay. Gavin Newsom.
And I saw that at home.
Did an interview. Someone's got the link. Is this it? This is okay, perfect. This is the timestamp. Thank you. Gavin Newsom did an interview with Ezra Klein where he explained where he got his new idea to focus more on affordability. This is going to be horrendous for my ego. I have to promise you, this is going to be horrendous for my ego. 1705. Let's see what Gavin Newsom says here.
I thought one of the most interesting shows you did was with streamer Atrioc.
Yeah, thank you.
Yeah, what did you take from that conversation?
You know what's so interesting? He was wonderfully combative with me. I kept wanting to talk about his history as a streamer and a gamer. Mm-hmm. He had no interest.
Listen, Gavin, I'll talk to you about Hitman. It was the timing. It was right after. You know what I'm saying? I'll talk to you about speedrunning, bro. I'll talk about Fortnite. I'll do it. The timing wasn't right, and I wanted to make sure that I got this part of the message across. I do want to start talking about Gen Z men.
Yeah.
And the issue I'm seeing, not all of them are like this. It's a broad, diverse group, of course. And it's a huge point of my audience. And I'm hearing their thoughts a lot. They range from angry to openly nihilistic.
He said, I'm coming on because my audience is pissed off. Pissed off with you, pissed off with everybody. Democrats and Republicans. You're not listening to us. They're struggling, they're suffering, and you're not listening to us. It's not about gaming. It's not about Discord. It's not about Twitch. It's about what the hell you guys haven't done to address the crisis for so many young people and how they're feeling today.
If I could boil it down to one word, it's like radicalism is when no house. If you can't get a house, if you don't see a path to get a house, and I hear this all the time. I said that. Holy, who is this harlot putting his ankles out, bro? Who is this harlot? And by the way, why did I say one word? One word? It's hyphenated. You fucks. It's hyphenated. Radicalism is when no house. Okay? And I got my ankles with these super no-show socks. My fit is embarrassing. But I stand by what I said. And I'm actually kind of impressed. I thought he didn't care. That's actually, I find it kind of cool. He listened. It's been months now. You remembered it? Some of them are working. They're working decent jobs. They're working hard. It's not even feasible in a lot of these cities to ever get a house.
And it was remarkable. He kept coming over and over and over.
Once you feel like you can get on that ladder, you're okay. You can calm down. You can find a party. You can vote. But if you can't see that, what's the point? Why am I doing it? Why am I working this job for a boss I hate for wages that are only okay? I'm never going to get another step up. So yeah, I feel like I've said that enough.
And it was not just...
Dude, I did feel like that. In the interview, I was like, damn, I'm just repeating myself. By the end of it, I was like, fuck, dude, I should just talk about something else, bro. I feel like I'm just hammering the same point, but that's all I wanted to say. That's all I wanted to say.
Illuminating. It woke me up. Wake up. Wake up, Democratic Party. Wake up, everybody. People are suffering and struggling. And look, it's Trump understood that in a contemporary term. I didn't understand that in this terms. I was out there making a case, and I was one of the last men standing for Biden. I was out there literally up
Biden's
until
strongest
the end,
soldier,
right? And I was talking about the economy in the aggregate, 15.4 million jobs, 8 times more than the last 3 Republican administrations combined, the best jobs market since the 1960s.
Yeah, I hated that.
All of these things that were true. All that said, I missed the obvious point. That's in the aggregate. We're talking about the economy. We're not talking about the American people. We're not talking about people's lived experience. And we missed that. And with Atrioc, he kept bringing that back, that systemically for decades, this economy has not been working. 10% of people own 2/3 the wealth. Half the consumer spending is that top 10%.
Bro, this guy might be president. Bro, I got Brandon G.H. Ewing got this guy that might be president to realize that. That's crazy, bro. That's crazy. That's crazy.
This thing, the stock market is 7 damn stocks, maybe 10, but primarily 7, mostly in California. And so that reality, he burst in a way that pierced me even more than all the intellectual punditry, the things you've written and other people have written, because
He's just that's so funny. Holy shit. First of all, the Glazed is crazy. Thank you, Gavin Newsom. But he little broed Ezra Klein. Any more than all the intellectual nerd shit. That's so funny.
Gotta make it personal here, man.
But it's not nourishing the economy for enough people. People are living on edge. Mm-hmm. And I saw that at home. I lived that reality. But it's deeper than that now. I mean, we were able to finally afford a home.
You needed to, I think somebody listening to this could say, look, you're the governor of California. Nobody was unaware that inflation was punishing people, that
9.1% at peak. Yeah, of course.
That homes had become extremely unaffordable for young people. Nobody was unaware that there was pain. I mean, when you say it burst
Listen, I'm writing a new book, and it's called Radicalism is When No House, a.k.a. Abundance 2. I'm taking your job, Ezra. I'm fucking stealing. I want the money. I want the fucking Glazed. I think that's the clip I'm in, right? That's the clip. That's the anyway. Oh, dude, that's so funny. All the top comments are fucking. Can't wait for Atrioc to react to this coffee Cal mentioned. This is gonna help with the Atrioc meme. That's so funny, dude. That's a hoot. That's cool. Shout out. I didn't know that left any impression on him at all. So that's cool that there was some change there. I mean, and you have seen, I mean, not Gavin Newsom particularly, but Democrats in general, not because of me, but in general, I've been running on a more affordability platform and doing quite well. Didn't Miami just get the first? Yeah, Miami just had the first Democratic mayor in 28 years. Since 97. Like all these, I mean, it's a landslide. It's a backlash, dude. I do want to make a separate video on it. I've talked about overtimes, but Trump's washed, bro. The affordability's killing him. It's slaughtering him. People legitimately thought he was going to bring prices down to 2016 levels. That's what they thought. And it hasn't happened. And now all the culture war stuff is not hitting as hard. And that's not saying nobody's hitting with it, but it's not hitting as hard. And then he's going out there doing, affordability's a hoax. It's a Democrat hoax. It's just a bad look. We have an A+++ economy. That's what he said. He said, grade the economy right now. And he said, it's A+. Actually, it's A++++++. That was his answer. That's not hitting with anybody. That's the Biden-Kamala move, dude. It didn't work. Anyway, that's a cool thing to see. Cool interview. Appreciate it. Ezra Klein stuff's interesting, bro. I'm not. There's a lot I don't agree with Ezra Klein on, particularly. I think honestly, Ezra Klein is a victim of horrible vibes more than anything, though. But what I will say is, I can't stand hearing anybody on the internet talk about the book Abundance, because I just know that the pro-abundance people and the anti-abundance, none of them have read it. None of you have fucking read it. It makes me so frustrated to hear you guys talk about it. I can just tell. I can tell instantly. None of you read it. You don't know anything in it. You don't know anything about it, bro. And you have such strong opinions on it for having not read it. And honestly, if you are somebody who have you guys seen the Zoran video where he talks about halal carts? Have you seen this?
New York is suffering from a crisis, and it's called halalflation. Today, we're going to get to
If you've seen this video and you liked it, you would like the book Abundance is this video written down 100 times in a row. I'm not saying abundance should be the fucking movement. I'm not saying that there's like corporate leeches trying to use that word to get around any real change. That's all true. But the actual substance of the book is just like, hey, there's like these weird fucking counterproductive regulations that cause things to be more expensive. It's actually very true. I don't know. It's frustrating. It's frustrating because if you like that video and you didn't like the book, then I think you haven't even read it. You have no idea. However, man, I think Ezra Klein has said some weird shit lately about like, we need to run anti-abortion candidates to get votes, and and Charlie Kirk was the best of us. He said some weird shit. Like he's so I'm not, but in terms of abundance, particularly, I read the book cover to cover because we did it for the book club, and it's like there's nothing in there. Dude, what's extra annoying to me actually is you got some real, Discord hardcore people who have such strong feelings about it. There's like a full unabridged chapter where he just prints Karl Marx. Okay. I made a meme for Aiden. I wonder if I still have it, dude. It's like you guys don't know shit about the book. You guys are so strong feelings you don't know anything about it. So, anyway, that's my take on that. Anyway, I would be happy to talk to him. I'd be interested to talk to him. I didn't know he even knew. It's funny, he brought it up to Gavin, not Gavin brought it up to him. The podcast clip isn't over. Am I mentioned again? I'm not watching the whole fucking podcast. What's this? Oh, wait. Aiden's messaging me and saying it's an emergency. Oh, God. It's probably that he bought too much fucking Montclair and needs me to... Oh, this is actually really sad. Oh, fuck, dude. It's not sad like you're thinking, but we recorded an episode of Lemonade Stand yesterday where we all dressed up like Steve Jobs and did pitches for really bad products. And I thought it was really fucking funny. And apparently the lav mic audio when we're doing the pitches is like bad. And we might not be able to fucking use it. Oh, it's so sad. I'm going to be fucking pissed. We might have to dub it. Oh, God. I hope there's a way to fix it. I thought that was a great episode. I'm not going to be so mad if that's not out. AI to fix it. So-called AI haters when it means they can't get their podcast episode. AI will fix it. AI will save it. AI will save the economy too. No, I don't know. We'll see. I don't know. I'm not a fucking expert. I'm not an audio expert, as you guys well know. Just disclaimer it with a timestamp to skip. Well, the thing is like it's the whole fucking app basically is us doing these pitches. Like, if it's bad, it'll be bad. Damn, that's annoying. That's annoying. Hey, Atrioc, first time chatter, long time VOD frog. Thanks for the glizzy entertainment. You didn't have to say glizzy, but I appreciate that. Thank you. Yes, just have Sea-Dog dub all three of you. That sounds bad. Do you think Democrats focusing on affordability is just the consequence of them not being the party in charge like they were during the last election? They couldn't say affordability is bad when they're the ones in charge, but now they can. Yeah, it's part of that. Well, that's what I'm saying. It doesn't even matter what they say, bro. Particularly, it's that unless there's a revolution, it's going to flip back and forth in our system until people finally get an economy they feel good about. The economy is the number one issue, and everybody is angry about it. And that is they're going to keep searching around for a different solution. Okay? They're going to try things until they get it. So I think it's smart of them to focus on affordability because it's the issue that actually matters. It is the fucking number one priority for people. They can't focus on other things if they are feeling themselves slipping behind the cost of goods. If they can't afford their lifestyle and it is falling, like they feel like they're getting worse than their parents. That's all that matters for voters. Voters haven't heard about Banana Farm's forehead. Listen, I think it's a good sign. There's going to be some people that pick it up as a talking point. They don't believe it, but that is a natural consequence of it actually being a important issue. Like it's the forefront issue. That's fine. I'd rather people not talk about it and not mean it in their hearts than not talk about it at all. It's progress. People talking about affordability as the key number one issue is important because it is the only way to get back to a stable society. Is this accurate? She recession on my indicator until my truck sales are down. Yep. Banger. I recently joined the community. I saw you from Lemonade Stand, thought your content was informative and interesting, but I still don't get the memes. Everybody at Zalby and say glizzy, 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 coffee, moo. All right? Catch up, Zalby. Catch the fuck up. Okay? Catch up. We're different. This isn't the Ezra Klein show. Spiteful Batman, thank you for the 32 months. Sorry, I missed that. That was a very nice message. Lunch Lady Arms, thank you for the 2 months. Mad Swell, thank you for the 3. Luz K2, thank you for the 56 months. We are very welcoming. Do you have a notion why everything's getting so unaffordable? It can't just be corporate greed? Dude, it's not corporate greed. That's the opposite of what I've been saying. Corporations are always greedy. They always have been, they always will be. They didn't get more greedy. They've always been as greedy as max possible. It's antitrust, so there's monopoly, so they can afford to raise prices more because they have no competition. And then it's money printing. Just an absurd amount of new money into the economy. That causes inflation. So those are the big reasons the prices, those two things more than anything else. It's monopolies and it's currency debasement. That's what causes prices to rise. There's other things, there's other factors, obviously, but those are the big two. Have you seen Hoser's video on Sudan? Yeah, we watched it yesterday. Are they not increasing prices over inflation rate like McDonald's? I think I've asked this before, but it's like a core question. If I ask you, is McDonald's greedy? You should say, yes, of course. They're a greedy corporation. Like every corporate, everyone's greedy. They want the maximum amount of money. And then I ask you, why don't they charge $100 for a burger? You have to be able to answer that. You need to if you can't answer that question, then you don't fully your system is all, why don't they charge $100 for a burger? Because no one will buy it. Because people will go elsewhere. Because they have some alternative. So they charge the maximum they can before you start leaving. So, like all markets, if there is more competition, the maximum amount they can charge is limited. Do you understand? This is the most core question. If people can't answer that, then their ideology is stupid. Like they're just a rager. They just want to rage at the world. But they don't understand anything. If you don't understand like that core question of why they can't charge that much, why they have to choose the prices they do, it's fundamental. So that is why strong antitrust and FTC is important. And that is why we don't want infinite amount of money printed out of the government to put in the economy. The best system you can have is one where if somebody is overcharging you or giving you bad service, you can say, fuck you, I'll go down the street. I'll go elsewhere. If your landlord's overcharging you, you can go, oh, there's a better deal down the street. If the burger's overcharging you, if your Netflix is overcharging you, you can go, fuck you, I'll go elsewhere. That's what you want. If you don't have that competition, then they're going to keep raising prices as much as they can get out of you. Okay? That is the idea. My streamer too? Dude, if I was the only streamer on Twitch, if they banned everyone else, banned Kai Cenat, they could only watch me, I would raise prices. I would charge those fucking kids. They got up there stuck at home brain rotted. I would gamba and I would raise prices. I can't do that. Okay? I can't do that because anyone can go anywhere else. There's plenty of alternatives. People aren't mad about competitive markets like choices of YouTube channels to watch. They like that. They get a lot of options. People like YouTube because they see a gazillion different options and things they're interested in. If somebody does bad content, they can go, I'll go elsewhere. They like Steam. There's a million games competing for your dollar. So they drive prices down. You get Hollow Knight Silksong for $20. prices down, competition up, more opportunity, more innovation. They don't like competitive environments. They hate cable companies or options where you have nowhere else to go. You have one fucking solution and they can charge you whatever the fuck they want. And if they give you bad service, you can't go anywhere. They hate that. That is the core. You have to do, it's like the number one job of a good government is to fucking oxygenate the market. Do whatever you can to break up the fucking ossified single monopolies and make a lot of competitors. Turn it from ossified to yossified. It's a great way to put it. If you listen to Crown for Kings by Black Thought, it's an unrelated question, but there's not a single Black Thought track I haven't listened to. I promise you that. I got the deep cuts, bro. I got like roots unreleased tracks. I'm Black Thought crazy, bro. Yes, I listen to Crowns for Kings. I listen to his solo albums. I listen to the stuff with Danger Mouse. I listen to the Black Thought is just yapping over mid beats. Okay. Chat, I'm gonna end on that rage bait. I'm gonna end on that rage bait, bro. I'm about to crash out. We're still in the year of kindness. I'm about to end. I'm glad I got to cover that. That's Gavin Newsom stuff. I might be live later, maybe for a little dispatch, but I also might watch the Lakers straight up. I got a feel for you. I'm gonna raid Ludwig. Thanks for watching today. That was fun. I'm gonna raid Luddy. Give Lud some love. They're doing a fucking awesome marathon Dark Souls stream. I might even watch a bit myself. Appreciate you. Thanks for watching. Goodbye.